Every trader wants to understand market structure, but most traders skip the foundation. They learn break of structure. They learn change of character. They learn trend direction. Yet they still struggle to read the market correctly. Why? Because a single mistake in identifying a swing high or a swing low can completely change your view of the chart. In this video, you'll learn how to identify valid swing highs and swing lows the right way, so you can read market structure with confidence and stop making the mistakes that trap most traders. Why most traders get it wrong? Most traders think every high is a swing high, and every low is a swing low. But the market doesn't work that way. If it did, every trader would read the same chart the same way. But that's not what happens. Put 10 traders in front of the same chart, and you'll often get 10 different opinions. Some see an uptrend, some see a downtrend, others see a range. The reason is simple. Most traders don't know which highs and lows actually matter. And until you understand that, market structure will always look confusing. So before we talk about structure, let's start with the first piece of the puzzle. What exactly is a swing high? A swing high is not just any high in the market. A swing high is a point where price moves up, creates a peak, and then moves back down. In simple terms, it's a high that gets rejected. Price climbs, reaches a top, and then gets pushed down. Think of it like a hill. Price goes up the hill, reaches the top, and comes back down. Now here's the important part. A single candle means nothing. A wick means nothing. What matters is structure. A swing high is confirmed only when price moves away from that high. Without that movement, you don't have a swing high. You only have a temporary high. And that difference is critical. What is a swing low? A swing low is the opposite. It is the point where price stops falling and starts moving back up. Again, not every low is a swing low. Price can create many temporary lows, but a true swing low needs structure. Price moves down, forms a bottom, and then moves back up. That bottom is your swing low. Think of it like a valley. Price drops into the valley, hits the bottom, and climbs back out. Now, here's the key idea. It's not about the candle. It's about the reaction. Did price just touch the level, or did it actually move away from it? That reaction is what defines a swing low. And just like swing highs, confirmation comes only after price moves away. The rule most beginners miss. Now, here's where most traders fail. Not every swing matters. If you zoom into any chart, you'll see hundreds of highs and lows. But if all of them mattered, market structure would be useless. So professionals filter them. How? They focus on swings that create strong reactions. If price creates a high and then drops aggressively, that swing becomes important because the market reacted to it. But if a swing forms and price barely reacts, it's just noise. Here's the simple rule. Strong reaction means important swing. Weak reaction means unimportant swing. Another key idea. Structure is not about prediction. It's about reaction. Every trend starts with price reacting to key swings. And once you understand which swings matter, everything becomes clearer. How swing highs and lows build market structure. Now let's connect everything. Swing highs and swing lows are not random points. They form structure. They show who is in control. In an uptrend, price creates higher highs and higher lows. Each swing high is higher than the previous one. Each swing low is higher than the previous one. That means buyers are in control. Price moves like a staircase going up. In a downtrend, price creates lower highs and lower lows. Sellers dominate the market. Every rally is weaker. Every drop is stronger. But here's the important part. Structure is not candles. Structure is swings. a single candle can mislead you. A swing shows the real story. And if you can read that story, you don't need indicators to understand trend direction. Common mistakes. Now let's talk about mistakes. Mistake 1, marking every high and low as a swing. This creates noise, not structure. Mistake 2, identifying swings too early. A swing is not valid until price moves away from it. Mistake 3, ignoring context. A swing without context means nothing. And mistake 4, overreacting to pullbacks. A pullback is not a reversal. It's part of structure. If you avoid these mistakes, your chart reading improves instantly.
Let's lock it in. A swing high is a rejected high. A swing low is a rejected low. Not every high or low matters. Only swings that create reaction matter. Structure is built from swings, not candles. Uptrend means higher highs and higher lows. Downtrend means lower highs and lower lows. And most importantly, if you can read swings correctly, you can read the market.
Now you understand the foundation of market structure. You know what swing highs are, you know what swing lows are, and you know how they build trends. But this is only the beginning. Because reading structure correctly is not just about swings. It's about how price moves between them. And that's where things get deeper. Inside every trend, the market moves in 2 phases: impulse moves and correction moves. So in the next video, we're going to break that down step by step. You'll learn how impulse moves really work, why corrections happen, and how professional traders use them for entries inside trends. If this video helped you understand structure, make sure to subscribe, because from here on, we build everything step by step. No confusion, no indicators, just price behavior. And in the next lesson, we take everything you just learned about swings and connect it to impulse and correction. See you in the next one.